What's going on, guys? MMuniz here. Welcome back to the channel. Today we're going to discuss what I consider to be the perfect passive income portfolio, and it's going to be a 3 ETF portfolio. The 3 ETFs we're going to talk about are going to be SCHD, my personal favorite DIVO or DIVO, and the new income ETF from JP Morgan, JEPQ, so JEPQ. Now in the past, I've made videos with detailed breakdowns of each of these ETFs individually. You can find those in the description down below. However, we're going to talk about why when you take the 3 of these and you put them together, it makes such a great combination. So in this video, I'm going to give a brief breakdown of each of the ETFs, and then we're going to seek to answer 4 questions. The first question is going to be, how did this portfolio achieve high income on a monthly and quarterly basis while it's still providing capital appreciation? Now the second question is, how does this portfolio maintain balance? Is it diversified enough to succeed in all market conditions? Downward market, flat market, volatile, upwards market. How do the holdings of each of these ETFs help us achieve that? Now the third question kind of goes hand in hand, why I like this portfolio in particular, is how does it reduce volatility overall? So in volatile markets where you're seeing massive decreases in certain stocks that have been absolutely crushed like they have recently, how will this fund mitigate those issues when it comes to downward movements in the overall market? And the fourth question we're going to look to answer is, who is this portfolio for? Is it for everybody? Is it only for someone in retirement? Where should these funds be kept? I'm going to give you my best opinion on that. I do want to make 2 quick notes. One of them is that this video is not financial advice. These are just my opinions. And then lastly, past results don't guarantee future results. So just because we've seen how some of these ETFs have performed during a bull market or during a bear market or even during a massive crash within a short period of time, it doesn't mean that the same thing's going to happen again. So just keep that in mind. Now with that being said, if you work hard for your money and you want to make it go further, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to personal finance or fitness. And with that being said, let's get into the video. So first things first, we got to break down these ETFs individually, and we need to figure out why they have a place in this passive income portfolio. Now, the first one we're going to talk about is going to be DIVO. DIVO is an actively managed fund that holds around 25 holdings, and the holdings consist of large cap, dividend growing companies. So this fund is looking for companies that have grown their dividend on a consistent basis long term. So the great thing about this ETF is it pays a monthly dividend, and it's broken down into 2 categories. Basically, you're going to get dividends from the companies that it holds, which the good thing about that is some of those can actually be qualified dividends. And then you're going to get distributions from the options premiums that the fund receives because they write tactical covered calls on a monthly basis. And when I say that, what I mean is they don't just write a blanket covered call option on the entire portfolio. They don't do the same thing every month. The fund managers try to be strategic when it comes to writing covered call options. You're going to have a 0.55% expense ratio, and in general, you get around a 5% dividend when it's annualized. But remember, this is paid out monthly. So now we're going to talk about the JP Morgan fund, JEPQ. Now there's not a lot of history because it's not even a year old. When we compare that to DIVO, which is over 10 years old, it may be a bit concerning. However, we are going to talk about the strategy, and also the company has a brother ETF called JEPE, which is super popular and has provided fantastic results. So JEPQ has a 0.35% expense ratio. It has a fantastic dividend of over 12%. When you're looking at the dividend yield here, you're seeing a higher dividend because the fund has lost some of its NAV. That's just how the formula works. However, I think around a 1% monthly basis dividend would be an average expectation for this fund. Now, the great thing about this ETF is it allows us to have that capital appreciation long term, while it still provides income on a monthly basis. At least that's what the fund manager's strategy is. And to do that, they have 1 month out of the money call options, and that's typically what's giving you such a high premium. And there's a lot of volatility in the NASDAQ 100, so that's why they're going to have pretty high premiums, which is going to give you that high dividend return. Now, the only other thing I'm going to mention is that the dividends from this one are typically not going to come from the company holdings. So when it comes to taxes, you're not going to have the qualified dividends. You're more than likely going to be taxed as ordinary income due to those options premiums. So that is one thing to keep in mind. But in general, JEPQ is giving us that balance by pretty much being the exact opposite of DIVO, where you have a lot more volatility in the stocks and, potentially a lot higher monthly distribution. Now, the third ETF we have to discuss is a lot different from the others. Now, this one doesn't use any options premiums or anything like that. It doesn't even pay a dividend on a monthly basis. It goes quarterly. But what we have here is the Schwab US Dividend Equity ETF, which is SCHD. This is a very popular ETF with over $46 billion in assets. It's been around for a long time. Its expense ratio is a strong 0.06%, which is extremely low. And in all honesty, this ETF has done extremely well when compared to the S&P 500, with some years where it actually surpasses the S&P 500 on a consistent basis. So what does this ETF hold? Well, this ETF holds typically around 100 companies, and what it's looking for are high dividend paying companies that show sustainability when it comes to those dividends. And in addition to that, they're looking for strong financials when compared to other options. Now, when it comes to the dividend, you're only going to be around 3.5%. And if you look at the trailing 12 months, we're at 3.39%. However, this fund has shown such strong capital appreciation long term that I think that even though it has a lower dividend and it's offered on that quarterly basis, you should be able to expect strong capital appreciation long term with minimal volatility, because typically dividend paying companies tend to have a little bit less volatility versus a growth stock like Tesla or anything skeptical. But at the end of the day, with SCHD, you're getting a really strong ETF that has great holdings, but also provides preferable tax treatment. So definitely something to consider. And that's why I think it has a place in this portfolio. So now the first question is, how does this portfolio provide high income and still allow for capital appreciation? Because that sounds like the best of both worlds. So what I have here is I've just done 2017 to 2023, an initial investment of $30,000, and then I'm using DIVO, SPY, which is the S&P 500, and SCHD. I'm not doing JEPQ because there's no history for it. It hasn't been around long enough. But let's just take a look without reinvesting dividends. So when we scroll down, we see that SPY and SCHD are almost identical, 53,000 and 54,000 in terms of the final balance. DIVO is considerably less, but remember, this is without reinvesting dividends. So right here alone, our $30,000 investment has gone up to mid $50,000. So it shows capital appreciation, even with DIVO, which focuses more on those options premiums, because remember, SCHD does not do that. Let's just add in dividends really quick just to see what happens. So when we add the dividends back in, now we're a lot closer. We're at 60,000 for DIVO, 60,000 for SPY, and 64,000 for SCHD. So we can see right here, all of these ETFs have gone up in net asset value. They've provided strong dividends. And the reason that there's no cap on growth, none of these are ETFs that write covered calls on the entire portfolio. And also the covered calls are not written at the money. That's when you start to limit your capital appreciation, is when you're using the whole portfolio. But if you're only doing a small portion of the portfolio, if the underlying holdings in the ETF go up, then the entire ETF is going to go up as well. So great opportunity there. So the next question is how does this portfolio reduce volatility compared to the overall market? And the big answer there is with the two funds that offer the options premiums, you're getting a significantly higher return just because you're getting those distributions. So even as the market is declining, you're still collecting that money. Now, in addition to that, it also depends on the holdings of the ETFs. Luckily, with these holdings, we have a pretty good diversification. We have DIVO, which is focusing on the dividend growth. We have SCHD, which is focusing on high dividend paying companies. And then we have our growth in tech, which is going to hopefully give us that little bit of boost in bull markets. But we're also getting really good returns from the options on JEPQ as well. So another thing to think about is QQQ is a perfect comparison for a time like right now. When we look at the past year, SCHD and DIVO are only down 3.5% and 4.5%, and that's without dividends. When you look at QQQ down 20%, the NASDAQ, JEPQ is going to follow that same trajectory. The only difference with JEPQ is that with those options premiums that it receives, any excess premiums that aren't paid out to the investors are going to be reinvested back into the fund, which is going to give us slightly less drawdown than you're going to see if you had just invested in the NASDAQ 100. So overall, yes, all three of these ETFs are going to help us in terms of volatility and help us in terms of drawdowns. So the last question we need to answer is, who is this portfolio for? Well, the easy answer is someone that's retired. So whether they've finished their working career or they're part of the FIRE community, the financial independence, retire early, this portfolio should provide you with a pretty high income return and still allow for that capital appreciation, or at least not capital depreciation. So you shouldn't expect your nest egg to disappear with this. However, I also think that the investor that likes to see a return on the monthly basis, I think it's going to help them a lot psychologically when it comes to continuing the grind, continuing to dollar cost average on a weekly or monthly basis. When you can see your monthly dividends growing or your quarterly dividend growing, it makes it a lot easier to stay positive. Even in down markets, If you had been holding something like the NASDAQ 100, which has shown fantastic returns in the past 10 years, it may be a lot harder when you see yourself losing 30% in a year. However, with holding these funds, even though the market's been dropping 15, 20, 30%, some of these funds have only lost like 3 or 4% without including dividends. So I think that's really going to help people long term in terms of persevering in their investing journey. But I want to know from you guys. Let me know in the comments down below, what do you think of this portfolio? Do you think an ETF should be replaced with something else? Or maybe you think it shouldn't be evenly weighted? I want to know from you guys. I do my best to respond to all comments on all of my videos. And with that said, thanks so much for watching this video. I hope to see you guys next week.